There are actually 6 segments that I look at. The business, the financials, and valuation. And the valuation, I put it at the last. And I share with the students, I'm structuring it this way by order of importance. The most important thing is the business. Although a lot of times businesses is a bit, the quality of it is more intangible. Then I go to the financials, which is more tangible, and valuation, which is also pretty tangible. What I mean is, today we may know how to. I said, what is valuation? I think let's you got to give it a proper name, okay? So I'll say the valuation is not the determinants. Yeah. So it's not like trying to value a company and then set this very defined line. Yeah. If it's above that, means it's overpriced. Below that means it's attractively priced. It may be like that in the past. Later I will share. It's less so today. So what is valuation? Valuation is just a boundary to make sure that at least I don't overpay. So it's not a very hard and fast rule. Yeah. So I share with you this interesting cartoon, that I came across. So it's talking about Warren Buffett, as he progresses in his investing journey. Okay, so remember the teacher of Warren Buffett, Benjamin Graham, the person who wrote The Intelligent Investor. So he's talked about avoid loss, margin of safety, nets, cheap price. Okay, let me explain what Benjamin Graham means. You got to understand, Benjamin Graham is born in the Great Depression era. So he has actually seen his family almost going bankrupt. He said one of the story that really engraved in his heart was when his mom went to a grocer to buy a bread, and then she wants to buy it on credit, and the shopkeeper was asking, is Benjamin Graham's mom good for $5? Yeah, it means to give $5 credit to the mom. And when he was a boy, he saw it. He really gave him heartache, and hence when he grew up, he's determined not to have to fall into near bankruptcy states again, like in the Great Depression. So he was very focused on downside. Like he said, avoid loss, margin of safety, buy at cheap price. So Benjamin Graham is a lot focused on assets because he doesn't believe in future earnings. Yeah, he wants to only trust what he can see, which is the company's assets. So if the company has $1 million, and if you can buy at $500,000, he said that's a good company. It doesn't even matter if the company is making losses. Yeah, so long as you can buy if the assets are there and I can buy at a sufficiently cheap price, and I buy many of them, well, I would have been a great investor. So he really did quite well. And that was the start of Warren Buffett. Because Warren Buffett evolved over time. So if the word to define Benjamin Graham is assets, and in this era, valuation is very easy. Because I can say, look at the assets. If the assets is $1 million, then what is the price? Yeah, then I'll set a price. Maybe I will not buy more than 60% of its assets. Yeah, so that is the maximum price I will buy. So valuation is very important and it's very defined. Let's look at how Warren Buffett has evolved. Yeah. So second one, I just go to the third one. So we talk about pricing power, moats, capital allocation, quality business, high return on capital, non-cyclical. So these are the phrases that defines what Warren Buffett was buying. Okay, so he actually he did not follow strictly Benjamin Graham's rule. In fact, he wanted to buy good quality company that has got a consistent growth in profits, that's got very high competitive advantage. Yeah. So then the word is he will actually treasure near-term earnings. Yeah. And then they can be growing gradually. Because in this growing up phase of Warren Buffett, there was not much of this revolution, unlike the technological revolution we are seeing today. In that few years, there was not much of this revolution, because the last revolution was the Industrial Revolution in the early 19th century. Yeah. So there was no revolution, so you could buy really pretty stable company. I think those that what we call mature and stable company. You could buy those company and then just grow with this company. Yeah, let's say 5-10% per year. Yeah, over time, you actually do very well, and you can buy it cheaply. Yeah. However, today, So that is if the first one, the phase is assets. This one I would say is current earnings. Today, let's look at the bubble. Great business, compounding machine, worldly wisdom, Lollapalooza, reasonable price, low capital intensity. Okay, later I'll go to reasonable price because that talk about valuation. So today, this is the type of companies we are looking at. It has to be great business. It's not just good. It has to be great businesses. Yeah, that means the very high quality business. Yeah, that can be compounding, say 15-20% per year, because it is structurally growing. Yeah, it is actually taking away market share from existing players. Yeah, so that's what company we are looking at is this, and the word is future earnings. And future earnings is very hard to define. I say if you can find a company that can go perpetually at 20%, no price is too high to buy. You can buy at any price if it's growing at 20% perpetually. Of course, no companies really do that. So the more important thing then is not the valuation. It's really whether you can find the right company at the outset. If you can find the right company that can grow at just 15-20% for a reasonable period of time, say between 10 to 20 years or 30 years, you can pay a very high price for it and it will still be cheap relative to its growth of earnings. Yeah. But the thing is, it's not easy, to be able to foresee that growth in profits from where we are all the way to 10, 20, 30 years later. And hence, as I share with the students of my class, the priority has to go from valuation to the business. Yeah, to find the best business, the right business, the best compounder you can be finding. And sometimes we have to pay a higher price. That's why it's buying at reasonable price. It's not buying at cheap price for Warren Buffett now. So talk about valuation. So then, personally, I'll use this metric, price earnings growth ratio, not exceeding 3 times. Yeah. So that's a metric that I use, an easy metric to use. Price earnings growth ratio not exceeding 3 times. Yeah. So that is my yardstick. But I said that it's just a boundary to make sure that I don't overstep it. So I'm not going to pay that much attention to valuation, let alone spending hours to go through a valuation model. What's most important, as I say, has to go back to the quality of the business, which involves both an intangible factor and a tangible factor. Yeah, it's not just looking at the numbers. Although I know a lot of investors like to just look at the numbers because that's very tangible. Yeah, but actually the more important factors lies in the intangibles.